But just I want to dive a little bit more on the impact of credit card. It sounds like it's such a impactful kind of thing to have when it comes to borrowing money from the bank. It, beyond just like 3% of the 20,000. So how significant exactly, if we can talk about it in a quantifiable kind of way?
Yeah, I mean, I guess like there is two kind of components to this.
Yeah.
So, like I said, it does affect the amount you can borrow. If you have a credit card limit, whether you've used that credit card or not, that will reduce the amount you can borrow, and it could be like 30, 40,000. It can be quite significant.
Okay.
Running parallel to that, like Jess kind of alluded to, is the bank is looking at your ability to service debt, mortgages, credit cards, everything. If you're constantly living on a credit card and you're only making minimum repayments and you're not paying this debt down, is the bank going to be comfortable giving you like $500,000-$600,000 more debt if you can't show that you can even service a credit card? True. So if you're using them well, like a lot of people use them for their day-to-day spending, pay them off at the end of the month when they get paid, fine. Like you're building up a bit of interest, but you're kind of clearing it off. And you're managing it well. If you're constantly running it up to the limit and only making the minimum repayment, like, is that a good use of your money? Yeah. Can you then afford to pay a $500,000-$600,000 mortgage on top of that?
Jess, do you have anything else to add in terms of kind of setting up your personal finance to, not from a borrowing money perspective, but owning investment properties?
Yeah, I think it would be great to see people setting themselves up with a really good structure across their finances before diving into property. I think there's a few parts to that. Before diving into property, have a think about why you're doing it. So making sure that it aligns with your goals. I think being clear on what you're aiming for gives purpose to what you're doing. And then when maybe times get tough, you're making sacrifices or you're doing certain things, it gives a sense of purpose to everything. So we always start with goals first when we're doing holistic planning, which is, I think, something everyone should do. There's also an important part of the process that we go through with our clients, figuring out, do they have sufficient cash flow to comfortably manage this type of investment? So, doing your budget, understanding your income and expenses really well, making sure you've got good fat in the budget to make this work for you. It would really suck to get partway through this process and realize actually this is meaning that we're scraping and saving and really struggling to get through it. So making sure you're nice and comfortable with all of your budget and things like that before you dive in. And then also having a really clear structure in terms of your accounts. So I see all sorts of things with account structures. Some people have 30 accounts and that's really chaotic. Some people have one account and that's a different kind of chaotic. So sectioning off things, like I said, your day-to-day expenses, an emergency fund, which should be 3 to 6 months of your expenses, having different buckets, a handful of different buckets for different purposes, and certainly having your investment properties all run through a separate account to your personal stuff, I think is really important. Your accountant will thank you for it. But yeah, don't mix your investment property rates up with your personal rates all through the same account. We want that all totally separate and get that set up really well from the get-go. So yeah.
I want to talk to you specifically about leaving some kind of margin in the cash flow for owning investment properties, because that's what we come across with our clients in property management all the time, where the clients may be financially challenged or struggling a little bit because they don't have enough cash flow or buffer to manage unforeseen situations, which is not that unforeseen nowadays with sudden repair and maintenance or tenants running behind on their rent payment, and all kinds of situations can come up. What do you think is a healthy kind of buffer for property investors?
Yeah, I think that 3 to 6 months of expenses is a good rule of thumb for your personal situation. So if you think about that in terms of your property investment as well, you want to think about, like you've done your personal budget, you've figured out you've got cash flow like fat in the budget for a property investment. Now move across to your property and go, okay, what's my property budget? And actually map that out properly. Go to somebody who's done it before and understand the costs involved. And Laura is someone that would help with that. So you can go, what are the rates, the insurances, the accounting fees, the property manager fees. Map it all out so you have it in the plan. You know that on an annual basis, what are the top-ups that are going to be required on this property. And then I think a 3 to 6 month buffer of that amount would be probably quite suitable as well. Like you say, just to account for unforeseen circumstances.
Cool.
We always say that you should run your investments like a business. So you wouldn't let your business get to a point where you can't pay staff for 3 months, or you can't cover your outgoings on your office for 3 months. So yeah, definitely, like Jess is saying, keep that buffer of funds, periods of untenancy, like you said, unforeseen repairs and maintenance. Like, operate it like a business. It's not just this is another house I own, I'll run it like my own home. Yeah. You should definitely be having like a surplus of funds.
Cool. All right. Thank you, guys. I think that sums up the key points to set up finance successfully for property investing. I'll see you at the next show.
Thank you.